The market has begrudgingly pulled back over the last week's worth of trade, and it's our job to evaluate that pullback and build a game plan for the coming week's worth of trade. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so. And get this, I've got 6 additional trade ideas to share with you at the end of today's show, so stick around until the end. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we're certainly dealing with a solid red-bodied bar where the sellers were able to close fairly weak towards the lows of the week's range, but is it really all that impressive of a red-bodied bar? I would argue no. If we look back at recent indications of sell-side momentum, look at the size of these candle bodies back here. Even the SVB breakdown bar right here has a substantially larger candle size in terms of the real body compared to what we printed last week. So to me, sure, the sellers can get a little bit of a sort of gold star for the week by closing weak on the lows, but there's nothing impressive happening from a location standpoint. I guess it's just a great segue into location. On the bar-to-bar count, we only have ourselves a higher low and a lower high. It's very classically called an inside bar, and an inside bar always just indicates that we're dealing with balance. There was no progress made outside of the preceding week's range. There was no upward progress, there was no downward progress. So don't get me wrong, it's not bullish in the short term here, dealing with the chart in front of us, but in the longer term, we need to remember that we're still very much so in a weekly uptrend with lows, higher lows, higher lows, higher lows, and along the way, highs, higher highs, higher highs, higher highs as of 2 weeks ago. So is it reasonable? This continues to be the question on the weekly time frame. Is it reasonable that we pull back and search for a higher low? To me, the answer is absolutely. We can afford a little bit of a pullback here. Let's take a look at the volume profile first. This is going to kick off the weekly analysis here. What are we pulling back from is the first question. We are pulling back from a high volume node. So once again, is this a logical place for the market to start slowing down in the upward direction? The answer seems to be yes. If we think about the pattern we're breaking out of, we know that this is not only just like a sideways balance range, but you could refer to it as a couple of different patterns. You could call it an inverted head and shoulders, or you could call it a very simple ascending triangle breakout. That's what we've been doing on this channel. But in both of those situations, what's the key inflection point? It's still the high volume node just shy of 420. So is it reasonable that if the market pulls back, there's room on the weekly time frame chart to go all the way to 420? I would have to make the argument, yes. It wouldn't be pretty on the daily time frame, and it might be scary to get involved there, but from the weekly perspective, there is room to pull back all the way down towards this level. 420. A couple of other things that provide confluence of support there. If we come in with the Fibonacci's from the low of the March move right after the SVB breakdown, your 38.2 is stacked right there, 419.79, right? We're splitting hairs. Call it 420, right? The other thing we can start to incorporate here is bringing back the anchored VWAPs. And although the all-time high and the October low anchored VWAPs are not necessarily in play just yet, if we do something like this and remember our breakout point, the fastest one anchoring to that same low from the March move after the SVB breakdown, it's slowly starting to creep higher. It's probably not going to be there this week or the week after, but over time, if we get confluence of support, it just continues to build the case that the weekly time frame trend remains up as long as we're above 420. Now, we started to see a little bit of sell-side pressure. I don't want the bears to come out and say, I told you so. Bears, you will have something more substantial on the weekly time frame chart. Notice what I'm pointing to, weekly time frame chart. Something more substantial will happen if we break down underneath that level and then we do something like this. Call it a look above and fail. Absolutely. The pattern would suggest that we should go to the bottom end of the range. We simply do not have that pattern yet, and as long as we're above 420, there's a strong opportunity from what we just saw together for a weekly higher low. On the daily time frame chart, let's first evaluate the expected move. If you're not familiar with this study, check out the tutorial in the top right-hand corner. If we're contained by the upper bound, the number is going to be 438.71, and that, of course, would imply a lower high from the most recent high to the top. So that, of course, is not all that bullish, but at the bottom end, it's very, very nuanced, but technically, if we're contained by the lower bound, 427.66, that would be a higher low above the bull flag consolidation lows. In a picture-perfect world, that lower edge of the expected move wanted to be above the top of the flag breakout range. Unfortunately, it's not the case. We need to call a spade a spade. Expected move here is neutral based on that information. Lower high, but higher low. From a trend perspective, we're still dealing with a daily uptrend, lows, higher lows, higher lows, higher lows, searching for those higher lows. Remember that the key and ideal place for them to form would be around 429.25. We'll talk about that on the hourly chart in just a second. And along the way, we've been complemented by highs, higher highs, higher highs. We are pulling back from the higher highs. So once again, can we afford the higher low pullback? The answer to that question has to be yes. If anyone's arguing that the daily chart is already in a downtrend, I would kindly ask them to point out, where is the lower high and where is the lower low? I'm not seeing that, right? If we get a bounce here and once again reject the upper edge of the expected move, then fine, we will call a spade once again, and that would be a lower high. We do not have that yet, and we also don't have the lower low. We have not breached the lows of the flag consolidation here, the last higher low set from the trend count. So with all of that out of the way, I'm just trying to remind you of the confidence you should have in the trend here. I know it can be scary when a pullback starts to develop. Here's another thing that can add into your confidence tool belt, right? So since the October low, we've put an anchored VWAP on all of the major pivot points here. We're above the bulk of the band, and from the April balance range back here, we've anchored a dark green VWAP and a light green VWAP, so the worst possible trade location and the best possible trade location. And notice that even if we go to the lower bound of the expected move this week, we are still above those anchored VWAPs. And you could certainly make the case that these anchored VWAPs are much more important from a weekly perspective if we start to see the deeper move into 420. So it does mean that there is some downside room to move. We can make intraday trades in the downward direction, but at key support points, I want you to be thinking about, can we find a daily higher low here? So there's really a tale of two different things going on if we zoom way in to the daily chart. Sorry for that funky zoom, but for the most part, Tuesday's gap down cements a little bit more of the bearish activity for the week, right? So from there, notice that Thursday's gap down gives the sellers an opportunity to produce a gap and go, picking up some sell side momentum. The absolute opposite of that took place on Thursday, and we talked about this in the midweek market update, right? We talked about how this was a poor low. We could sweep those lows, and if we moved back into range, we should look for a move higher. Thursday's close was actually really, really inspiring for the bull side of the market, right? It was looking really solid with a close. We'll see this on the hourly in just a second, above some of the consolidation that we were looking for. Now, on Friday, we had the same thing take place. We gapped this time red under green. So all of a sudden, everybody who closed out long on the Thursday session is dead wrong, right? Nobody who initiated a new money long on Thursday was right on Friday morning. Everybody's underwater. But what happens, right? The market actually rallies into Thursday's range. Now, once again, we have to call the chart as it sits in front of us. We do have an inverted hammer, and we've rejected Thursday's range. But it doesn't strike me that stronger sellers are trying to get extremely aggressive in this market. If so, you would have imagined that they could have capitalized on the gap down from Thursday or the gap down specifically on Friday, gap red under green. Now, again, because of the upper wick from Friday's session, I do think that the bears are building a little bit of an edge, rejecting that Thursday range. Let's take a look on the hourly time frame chart and see what we can see from a confluence perspective here. So the most obvious pattern that we discussed on the Wednesday update was, of course, the head and shoulders. Now, notice what happens on Thursday, right? There's the gap down underneath the prior day's range. We move inside, get acceptance back above that neckline technically, and close strong up towards the highs of the day's session. It was looking very convincing into the close of Thursday. Once again, what happens on Friday? We gap down, then we see a rally and reject off of the neckline this time. So instead of recapturing it like we did on the Thursday session, we've clearly rejected that on the Friday afternoon breakdown, right? So what does that sort of imply? The sellers are technically making progress in the downward direction, but the nature of the sellers is that they are currently not looking like stronger, aggressive sellers trying to sell this market into the ground and push us back down towards that 420 level. So going forward into this coming week's worth of trade, what else can we use as confluence? Now that we understand the story, we understand what's taking place, we know who's in control, it's technically the sellers moving begrudgingly lower. I used that word very intentionally in the intro, right? But they can see some downside with the lower high from Friday. Notice also it's the 61.8 from this move that we've been evaluating with the fibs, the low of 3 Fridays ago to the top of the move. We are underneath the 61.8. You guys know if you've been tuning into the channel, that's a key line in the sand from a fib perspective. The more bars that we close underneath, the higher the odds of a 100% retracement. And lo and behold, where is that 100% retracement? 429.25. So with all of that kind of out of the way, now that we understand what's going on here, we can also throw on, I got one more for you. I know I'll speed it up after this, but if we throw on the anchored VWAP, right? This is also inspiring on the Thursday close specifically as well, because technically this consolidation back inside of Wednesday's range is underneath the VWAP. We actually poke above it into the close. So I will fully admit, Thursday was looking fantastic. I was ready to come into the Friday session saying, hey, we will look for upside given everything that unfolded. The gap down threw that completely out the window. So what does the VWAP tell us in this situation? As long as we're underneath it, the sellers are still technically in control. So this is your key zone. If you're only going to watch one thing into the early stages of this coming week's worth of trade, it's 430, 450, right? It's the neckline of the oh so obvious head and shoulders pattern. If the sellers can remain underneath it, we'll look for the full rotation 429.25. And then remember, from the daily perspective, what are we doing when the market gets here? We are certainly looking for hammer candles that take place. We are looking for double bottoms that take place. We are looking for inverted head and shoulders that take place at the top of the bull flag retest, which would technically be producing and looking for a daily higher low. So the game plan is to, sure, we can trade this if we reject underneath 430, 450, but the game plan is not to overstay your welcome, not to look for this to fall off of a cliff and go to zero, but rather see if we can find the daily higher low off of a manageable pullback 429.25. What's the bull case here? It's going to be the exact same thing as what we experienced on the Thursday session, right? So say on Monday morning, we open in this range here, we pop back over 430, 450, a higher low back inside of that range. I would start to think of this as a 3-day balance. This turns into a look below and fail. And even beyond that, right, you could even go so far as to call this a potential double bottom, recapturing the neckline, higher low back above. It's kind of game on, right? So 430, 450 is your number. Upside target will be the Tuesday high, 438, and from there, we'll walk up the targets to 440.75. We'll update you on Wednesday, of course, but for now, let's take a look at some supporting evidence. Exhibit A, as always, are the market internals. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. Let's keep it very simple. Yes, we do have significant outflows from this market, breaching negative 500 million. That is a very bearish indication. If we look at the advanced decline line on the week, none of the days actually spent time in trend lower zone here, so it is bearish being below zero, but not overly aggressive sell side across the exchange. I would say that the volume is the most bearish thing that we have on the dashboard in front of us, and remember that the tick will never lie to you. So the volume and the advanced decline line, those read from the prior day's close. So it's no surprise that when we gap red under green on the Friday session, that everything is very muted, everything is counting as outflow volume, everything is counting as a decliner here, but the tick will never lie. Remember that it counts literally the tick by tick moves across the exchange. Is there any cumulative build on this screen in front of us that breaches negative 4,000 or heck, even negative 2,000, half of what we would call substantial? Simply no, absolutely not. So intraday, are the sellers hitting it aggressively across the exchange? Absolutely not. This continues to build the case, in my estimation, that this is still a mild pullback until proven otherwise. Exhibit B market profile, if you're not familiar with this one, check out the tutorial in the top right-hand corner. Friday, value area and point of control are slightly lower in the profile, but they're not slammed dead on the lows here. It is a bearish move, of course, being disconnected from the value area on Thursday. That is noteworthy here. But notice what the Thursday low does. Once again, we gap down, right? We clean up the poor low from the Wednesday session, and then we closed fairly strong at the highs. You'll notice that we have decent excess on Friday at the lows and highs, not really leaving any poor structure in our wake. One thing I do want to point out, which would suggest, hey, maybe there is a little bit more downside to come, is if we look to our left, right, remember that this is the top of the inverted hammer back here, and then this is the follow-through breakout move. The market has left a virgin point of control VPOC, as we call it, down here, and that really does align more closely to the 429.25. This is your daily bull flag consolidation on the SPY, right? If I do something like this, we can kind of see that as a bull flag, right? So this thin structure that we were just illustrating can be retraced, and it wouldn't be unreasonable for the S&Ps to move back down to retest that, also noting that there is a VPOC there. If the market does decide to move higher, what should we be mindful of in the upward direction? Of course, it's just going to be the place where we've doubly rejected, basically, and it's the overhead range, the distribution number 1 from the Tuesday session. Remember that one up here, right? So that's going to be Wednesday's high, basically, around 44.32. To give you an idea of where that prior point of control was on the market back here, that number is at 43.55. That is your market profile. How about the sectors this past week? What was the weekly performance like? If we look at the top dog here on the list, it's the XLV. It's the only green name on the board, and technically that is D for defensive. But what we also know is that it's the second heaviest weighted sector by market cap. Maybe that is what's keeping the pullback from getting overly aggressive. But looking at the bottom of the barrel, which is technically towards the top, notice that we see real estate, energy, and utilities as the sectors that were down the most. Don't get me wrong, the XLK is still down substantially, almost 2%. Same thing with financials. That's really where the problem is, but the sectors that were down the most are the defensive sectors as the pullback has been unfolding. So should you be all that concerned? Like, is there a massive fall apart out of the tech sector, out of communications or discretionary? Absolutely not. Those were very mildly lower in the previous week's worth of trade. So it's not like there's a full flight to safety or risk off type move developing here. Let's take a look at these structural charts and I'll just point out some of the key nuances. Once again, XLV, D for defensive, but second heaviest weighted sector. Beautiful that it's just going sideways in here, holding the S&P basically, instead of adding to the sell side pressure with a big breakdown. Real estate, obviously with the talk around rates and Powell speaking multiple times in the previous week, it's moving lower, right? There's this firm implication that rates will be hiked twice into the end of the year. The tracker tool is not agreeing, but no surprise, real estate's lower. It's a lightweight sector for the market. Same thing with energy, approaching the bottom end of this consolidation. The concern here is that this is certainly turning into a descending triangle with lower highs in play. I would keep your eyes on 76. If that starts to break down, it would be a small cause for concern. Don't get me wrong, it's a D for defensive sector, but remember, if we're looking for healthy market rotation, we don't want these things falling off of a cliff. So watch 76 out of energy. Utilities is very similar in the sense that we are coming back down into the bottom end of this range here. It's kind of a failed inverted head and shoulders breakout with a big inverted hammer, rejecting the prior overhead supply. Now we're barreling back down towards that head. Once again, you're going to want to watch the bottom of the pattern here at 63.75, but still no concerns yet. We're not falling off of a cliff. XLK pulling back off of the all-time high basically. Was that to be expected? Absolutely. We talked about it in last week's episode, right? So no concerns here structurally. We're already testing the top of the flag consolidation range. We don't have the best looking candle on Friday, but if we can stay above 167.65, regardless of what the candle structure actually looks like, that is healthy for the market. We are seeing a reasonable pullback off of an all-time high. And even remember this, like if we zoom this chart way the heck out, think about a weekly high or low. Your weekly breakout point was way back here around 150, right? This really kicked things off. Could a weekly high or low technically afford the bottom end of the flag? Absolutely. I mean, intra-week, it certainly does suggest downside activity. I would be watching 167.65 very closely. Inverted hammer might suggest a breakdown of that. But structurally, it's not like a big risk-off move is developing with big deterioration out of the XLK. That's the main point, right? The XLF is where we really start to see some issues, and it's twofold. Structurally, we did not hold on to the neckline of this as a double bottom, right? This broke out. It technically did produce a higher high, but it didn't really produce the higher low that we wanted to see. On this pullback here, needed to stay over 32.85. Big concern that we're back down underneath that, kind of in no man's land down here. One of the big catalysts for the banking industry right now is the capital requirements that were brought up an insane amount of times during the testimonies from Jerome Powell this week, right? So we'll talk about that when we get to the fundamental piece, but that's what's putting downward pressure on financials right now. And I think that the pullback this week was really led by financials in terms of the heavier weight sectors that were pulling back, right? This is the more concerning one. It's been that way for a while. In terms of what the chart would imply, balance, choppy in here. There's really no edge. I mean, the sellers might have something going on more seriously, right? Might more seriously have something going on if we can get under 31.75. Next up, materials, lightweight sector, still sideways, no leadership issues, not falling off of a cliff, moving along. Industrials, back testing the top of the breakout range here. Ideally, it holds 103. It could find a higher low in range, just would not be picture perfect. You have to obviously contend with a look above and fail on the potential for a lower high back underneath. So watching that around 103, but 8% of the S&P 500, not a huge make or break. XLP consumer staples, anything concerning here? No. Not seeing leadership, not way up here, also not falling off of a cliff underneath the bear flag consolidation lows. Next up, communications. This is worth spending some time on here and in discretionary because of the weighting and just posture for the S&P. Is there anything concerning about this? Like, are we moving from lower left to upper right, or are we moving from upper left to lower right? I mean, the chart really speaks for itself. Nothing about this is concerning yet. There's the possibility of a head and shoulders emerging if we really start to like flush, something that would look like this. But once again, think about weekly perspectives. Structurally, is there anything wrong here? I have to answer that with no. We simply have a 3-day balance from the Wednesday, Thursday, Friday. If we look at the hourly time frame chart, there's your open underneath, gap down on the Thursday session, strong rally into the close. We do not violate or test the low on Friday, and we've closed back above 63.75. So no concerns out of communications at this point. If anything, you could make the argument for the exact opposite on the hourly chart like this. As long as we're above 63.75, look for the rotation back up to the equal high, right? So last but certainly not least is the XLY, and this, maybe there's a concern here for some distribution because the pullback has not really been lower via price. It's sideways through time here. But once again, structurally, is there anything that's suggesting that the XLY is in jeopardy of swiftly falling into a downtrend? I mean, look at this chart. This as a massive base underneath us. We had such an issue, remember, with that 148 level. Now we've firmly resolved it in the upward direction. I mean, even if this does pull back, what are the levels that we want to watch for? 160.50, even here would be fine at 157.85 roughly. From a weekly perspective. Again, don't get me wrong, intra-week, sure, it could put some downward pressure on the S&Ps. The level that you want to watch first and foremost is 163. If we're just chopping around in here, it's as neutral as it gets for the S&P, intra-week breaking down through it. Yeah, of course, we'll look for 429.25 on the downside, but structurally, hopefully through walking through all the sectors here, you can see there's nothing alarming yet about this pullback that's unfolded in the S&Ps. Here's the ratio grid. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. Let's keep it very simple and start inverted this week. So at the very bottom, these are the risk-off sectors. Is this a risk-off pullback? Simply put, absolutely not. Moving lower, moving lower, moving lower, moving lower. Is tech taking a break? Yes, it is. Is it still well above an upward sloping 50 SMA? Yes, it is. Is the financial sector still the problem for the market right now? Yes, it is. Does discretionary look good? Yes, it does. Closest tie here. Communications, flatlining, trying to pick up above an upward sloping 50 SMA. Let's take a look at growth versus value via the XLY divided by XLP. Well above, on the higher high, our prior pivot back here and prior support from back here. Very reasonable case to make that a pullback could continue. We talked about this last week. Find a higher low over 2.1 and we're still good to go. The pullback is very mild based on this relationship here. Let's continue along and just dive right into the dollar. That way we can hopefully save some time on cuts here. Dollar, what's going on? Certainly moved higher, and this would support the idea that the market moved lower into the end of this week. Now, this is a bit deceiving. The body on Friday is actually something that looks like this. Let's quickly bring it to a 15-minute time frame chart so you can see, right? So really like this, there is no large upper or lower wick that the daily chart is suggesting. And the main takeaway, and the reason I bring that up, is to point out that there's a gap to fill underneath us, right? So if we reject off of 103.50, that gap close should become the target. If the dollar does start to fall off of that, rejecting 103.50, which we know to be a key inflection point here throughout history, if we reject that, that should be bullish for equities down below. So a little bit more upside to test 103.50, reversing off of it would be helpful for the bottom or higher low to start to be found in the equities down below. Does the gold contract have any issues with that? Is there any discrepancies here? And I would argue a little bit. The gold contract certainly does not look good here, sitting at 1920, the prior breakout point from in here. In a picture perfect world, this was back in here. Remember that we talked about the hammer candle? We never really resolved either of those two hammers in the upward direction with conviction, and we're still underneath 2,000. So there's some disconnect from the dollar and gold right now. If the dollar is right, it would be helpful for equities down below. If gold is right, and it does continue to break down through this with the suggestion by the inverted hammer, that wouldn't really pose the opportunity for the dollar to help out with the higher low in equities down below. So that is that. Let's take a look at interest rates, and then we'll move on over to the Fed tracker tool. These continue to remain stable. So as long as we're in this new balance range here, fine. It would be helpful for the XLK if this broke down under 36.40. If it breaks the top of the range, you know the deal. Probably going to lead to deeper pullback across the market. But what does the tracker tool have to say about this? Still pricing in those higher odds of a 25 basis point rate hike for the next meeting scheduled for July 26th. No surprises on this screen right here, but if we take a look at the probabilities tab, this is where things get interesting. Remember that the SEP outlines a terminal rate getting close to 5.6. That would imply 2 rate hikes into the end of this year, but notice markets saying, nope, we're not buying it. We're only going to give you 1 rate hike and then we're higher for longer. We'll start cutting as soon as the calendar flips. So if you're a fundamentalist, tracking that 1 versus 2 rate hikes is probably the important thing to do in terms of the valuations of companies, right? 2 more rate hikes and it's, the market probably needs to come in a little bit more. 1 rate hike that's already been priced in, kind of good to go. The other thing that came up from Jerome Powell's testimony this past week in front of Congress and the Senate and all that good stuff is the capital requirements for big banks, right? They were throwing around the rough figure of 20%, a 20% increase in capital requirements for big banks. And if you look at charts like Goldman Sachs, Morgan Stanley, JP Morgan, all the big guys sold off hard on that information. Now, sure, it reduces the risk of a blowup, technically having more regulation, but it also reduces their profitability to some degree. They can no longer kind of be like, hey, what can we get away with and, make work for the sake of profitability? And, we're not going to get into the debate of that, but to me, the financial breakdown is really the most important thing to watch from the technical perspective because it should be expected that the XLK, the chart itself is fine. It's pulling back off of an all-time high, whereas financials continue to be a burden for this market, and this sort of more fundamental take on that would just reinforce that idea. We saw it in the structural chart, but the fundamentals would also kind of align. Now, if we look forward into the coming weeks worth of trade, we have to deal with PCE, but I'm going to give you a quick recap of services PMI. It came in above the expectation, which is not great if we want services inflation to start coming down. We want this number to get closer to 50, not 54.1 on the flash. So if we look forward, of course, a couple of things will be coming out this week. Powell will be speaking once again at 9:30, not making our job easy on the Wednesday session. We get final GDP on Thursday at 8:30, as we always get unemployment claims as well. And then we'll also see the PCE. This is the big deal on Friday at 8:30. This needs to come into alignment with inflation subsiding in services. Otherwise, I don't really think that the market wants to see the higher low be found easily, at least on the daily time frame chart. If this is a big miss out of PCE, you probably get more downdraft out of the market. That's kind of the fundamental relationship that's there. We'll still abide by the technicals and our levels, but watching this very, very closely on Friday morning. Risk appetite is still not showing any flight to safety out of the TLT if we look at this chart. Pretend that this is a trend line here. It will become concerning when and if we can breach this in the upward direction. Simply has not happened yet. It is a counter trend move in the context of an overall downtrend in the ratio. And you can see that the TLT itself up here really is not even close to breaching that 110 breakout point, which in theory could be the move that produces the risk off flight to safety type look in the ratio itself. So that would really, just reinforce the idea that it's still a mild pullback until proven otherwise. If we take a look at the HYG, this would have some very different opinions, right? With the dramatic lower low being found into the end of this week versus the equal low here basically out of the S&P equities. So if this is going to be correct, then we should look for a breakdown continuation of the neckline from the head and shoulders and watch for the more aggressive pullback into 429.25 on the SPY itself. But we can also counter this, again, back and forth, multiple data points. All of this is one data point in the web of analysis that we spin. Look at Bitcoin. This is much less of a relevant data point compared to the HYG, but with the BlackRock ETF coming out, this would certainly speak to risk on appetite in the financial system overall versus, hey, nobody's really interested in these speculative assets right now. This to me is a small, very small bullish data point. Breadth did not hold up too well during this pullback. You'll notice that new highs versus lows is right back down at the zero line. Don't get me wrong, it's not the end of the world until it starts making big time negative impressions here, but it's not what we wanted to see as the market saw a very mild and benign pullback thus far in terms of the price action itself down below in the S&P. If we look at something like the SPX A200R to get a sense for what's going on with stocks over the 200 SMA, we're still holding on to the 50% mark, but once again, a little bit sharp here. Would have been more ideal to stay more firmly up here with a mild sideways read, not a downside read for the week. Then the SPX A50R, I've got some evidence here that would suggest this is mainly due to the financial breakdown. And what you'll notice is that we're right back at the 50% mark. So in a picture perfect world, remember that this coincides with this breakout, this is not a good look out of the SPX A50R. But once again, here's the supporting evidence for the financials really leading the breakdown. So I've got a scan set up here. You can look at the criteria, take a snapshot, digest it. It's looking for crosses below the 50 SMA. Don't get me wrong, there's a mix of different sectors in here, but what is the dominating sector in terms of the large market cap? Look at financials, information technology, aka the XLK, really didn't account for too much of the breakdown across 50 SMAs on Friday at least. It was mainly due to the financials giving up 50 SMAs based on what we know about Jerome Powell's testimony. So you can go through this scan a little bit on yourself. You can set up the same thing and take a look. But for the most part, this is due to the drive lower from financials. Wanted to make that very clear here. It is a heavier weight risk on sector, but it's not the XLK and it's not the XLY in terms of consumer discretionary. Another bad look from a breadth perspective is the RSP. It did not find a higher low off of the ideal structure here at 145.75. As a matter of fact, it broke down through it and produced an inverted hammer, the upper wick rejecting the backtest intraday of that level. Now, let's be very clear. It's not that the RSP is in a downtrend. It just did not hold the ideal rainbows and butterflies level. You still have lows, you still have higher lows, and you still have an opportunity for higher lows, but it just wasn't at the key structure that we were monitoring. So not the end of the world, but not helpful as the market pullback has unfolded. If we take a look at the Dow transports, this is a little bit encouraging, just suggesting to keep an open mind. Notice that transports are consolidating high and tight up against this level, the equivalent of this one out of industrials. Industrials would say, not yet, but this at least is not coinciding with a big breakdown. It's not that we have an overly bearish look out of the Dow theory is the main takeaway, right? So far, a little bit more neutral as the pullback is unfolding, not outright collapse. VIX volatility, more new lower lows. Go ahead and call this one broken. That's fine. We, of course, have more data for you. Even as this pullback has unfolded, what did the VVIX do? Volatility of volatility is contracting. It is moving lower as the pullback has unfolded. It is not elevated over the 103, and it's not sitting here down in complacency zone around 75. So is this pullback aggressive? Is it unexpected? Absolutely not. It's almost like the market could see this coming and is like, all right, we're all good. We're slowly drifting lower. No issues from a volatility perspective. For all the diehard vol fans out there, we know that everything always stems from the VIX futures themselves. If we look at the front versus back month, we're still in a very strong contango, nowhere near the zero line up above. 9 versus 30-day VIX, well underneath the zero mark here. And even the one-day VIX, right? We've seen more aggressive reads in the upward direction out of one day as the market has been seeing some up and down swings, back in here, back in here, back in here. Again, this pullback is very mild based on volatility. Here comes the home stretch with the QQQ weekly time frame chart. What do we see from a structural and location perspective? Identical to the S&P with a small red-bodied bar. Sellers do close weak on the lows, but it's an inside bar with a bar-to-bar higher low and lower high, meaning that we are technically in balance, and we very well know that the QQQ weekly time frame chart is in a very strong weekly uptrend with massive new higher highs that were produced in the last 2 weeks worth of trade. So any concerns about a trend reversal here are simply unfounded in reality. Hate to be that guy, but technically the Qs could go all the way down to 320, find a higher low here, from there to there, right? That's the last major consolidation and pullback that we saw, and still be in an uptrend. Now, of course, there would be concerns if that did happen, and I'm not calling for that. I'm just illustrating the strength of the trend that we're dealing with currently. If we throw on the volume profile, what else can we learn about the QQQ? Is it reasonable, the location that we're pulling back from? Absolutely. High volume node, prior structure, a little bit of slowdown here in the aggressive uptrend that we've been on. Only able to produce an inside bar. It's not even like we saw a large red-bodied bar. Remember also that when we had the SVB Black Swan event, so to speak, the largest red-bodied bar that we've seen recently doesn't even come close to the 320 level, right? Just based on an eyeball test, well above that if we get a major breakdown like what we saw during the SVB crash back down over here. So weekly time frame chart isn't going to offer up a whole lot in terms of actionable setups into the coming weeks worth of trade. So let's go on down to a daily time frame chart here and see what else we can learn about the price action. The first and foremost thing I want to do is just remind you with our anchored view apps anchored to all of the major pivot points, right, from the October low, that we're above all of them. So once again, any unfounded claims that the QQQ is in jeopardy of reversing in the downward direction are simply not based in reality, based on the anchored view apps, based on trend counts, based on everything that we've looked at thus far. If we just quickly get rid of those, we'll go back to our 50 and 200 SMA, throw on the Fibonacci's, right, we'll even go from here, right? Instead of the low of the move, let's take the April balance range and the first candle break, which was right here. If we come from the low of that bar to the top, where's the 38.2? Even that is extended through the bottom edge of the weekly expected move. So speaking of expected move, let's zoom in, get a little bit more granular. We have ourselves a 3-day balance that really formed over the past week's worth of trade. The expected move is what? Certainly a little bit more bearish here with the same thing, lower high, just like what we talked about in the SPY, but from here to here, a little bit of a higher low. I guess from that perspective, it would be a little bit more bullish. The higher low is certainly more extreme than what we saw in the S&Ps, but for the most part, it all boils down to the resolution of this 3-day balance if we're looking to get active as, short duration traders, as in, day traders, scalpers, so on and so forth. So here's the hourly time frame chart. What else can we learn about this? I really think that the 360.75, it's too precise. It's too precise. The level has been tested too many times. There's likely going to be a strong number of stop losses that are underneath that should be swept, right? It's very clear also that we do have a series of lower highs on an hourly time frame chart. Sure, we're starting to drift into a small nuanced hourly downtrend. It will really be cemented when and if we can produce the lower low breaking underneath 360.75. So just like we had that main pivot in the SPY, the pivot out of the QQQ is 360.75 for all the reasons that we've just discussed. We opened underneath, right? There's your same rally, there's your strong close above, then we never test underneath again. So this is a weak level based on how we've interacted with it. I would not expect 360.75 to act as support once again. Breaking through it brings us closer to that 357.25. That should be a respected level from the daily breakout back here, but we've got thin structure to get us there in the first place, right? So breaking through 360.75, shorts are on the table to 357.25. You could look for a lower high underneath. You could even take the breakdown of the level, considering that it's been tested so many times and it is weak because of that fact. The issue with that would be that you need to have a stop loss in place. This is not like a, hey, I'm just going to let it run type of trade. We know that we're in a glaringly strong weekly, daily uptrend. If we sweep this and come back into the range with a higher low, just like what we talked about on the SPY, right? Same concept, different levels. If that takes place, you can't just be short from here and say, oh, I'm going to let it run. Right? If that happens, you better believe that we collected the liquidity, we grabbed the stops, and you should be looking for the highs in here at 364.25 as a trader, right? What else do we get? Any confluence of support or resistance with the Fibonacci's from the breakout bar? Remember, that's Monday back here. There we are. So I would still argue that this is more important. The 61.8 has not really been breached at this point in time. Use the structural element as a much firmer thing to be monitoring. How about the anchored view app? We've got to bump this forward by a couple of days here. There we are. And we're, of course, underneath that. So using that as a lower high. So two situations, right? Breakdowns here with a lower high. This range is tradable in the downward direction, reevaluating at 357.25. Hammer candles, double bottoms, inverted head and shoulders. You guys know the deal. A sweep here and then back in with a higher low over 360.75. This should become the target, and then I would reevaluate when and if we get there because of that anchored view app. For the best longs in the upward direction, it's a higher low over that anchored view app to just illustrate that everybody who's trying to participate in this most recent leg higher is back above water, so to speak, with their positions. That would be over 364.25. What about supporting evidence here in the QQQ, the NASDAQ side of the market? No substantial outflows on any individual day breaching underneath negative 400 million, but we do have substantial outflows on the week, getting underneath negative 600 million. Nothing down below in trend lower zone here, and you can see that the cumulative builds in the tick were far more aggressive in the downward direction on the tech side of things as the XLK basically pulled back off of the all-time high. So this begs the question, if the internals were more aggressive on the downside out of the NQ, the NASDAQ side of the market, why was it that we really saw a firm 3-day balance in play and we didn't get that rejection underneath here in the QQQ, right? That's what the SPY did. It really cements the idea that financials are the big issue with this market. You know, based on everything we've really unveiled today, financials must be the watch, right? That's, to me, the biggest takeaway from today's video. Financials need to start playing nicely with the other friends in the sandbox. What's going on with the NQ market profile? Inside bar on the Friday session. Value is inside and overlapping from Thursday. Point of control did migrate lower, but once again, there's not much to really glean from the profile, and we're just sitting in balance here. No poor highs or lows to deal with. We did technically, get some movement through the single prints from back here, and the issue just still remains 360.75 on your QQQ, the breakdown of 14,980 roughly in the NQ futures. If we scrunch up the chart, we know that we've got thin structure below us. That's that equal, or I shouldn't say equal, but that's the thin structure breakout we were just referring to in the QQQ. 357.65 was at the top of the flag range, right? That's going to bring you back down here from the profile perspective as well. You can see that thin structure. If I just zoom in, not a whole lot in terms of market profile there. In terms of the level, your number is going to be at 14,880. IWM weekly time frame chart. Remember last week we were saying one of these things does not look like the other, and it still remains the case. First and foremost was the inverted hammer from 2 weeks ago, and last week we printed a solid red-bodied bar, but notice that we have a lower low and a lower high. Definitely more bearish than what we've seen out of the S&Ps as well as the QQQ. So all things considered, sellers go 2 for 2, structure and location, but we do need to be mindful of the weekly 50 SMA coinciding with the top end of this weekly balance that we've broken out of. In a picture perfect world, we find support at this area and look for a return back up towards the equal high. We'll also recall that the anchored view apps from the all-time high and the October low in IWM are far more important to this analysis, noting that this all-time high is what started to lead into the rejection of the previous week, right? And also, this is potentially acting as support once again with confluence at the top of the weekly range here. If we remind ourselves of the volume profile, this should help as well. We do have a big-time anchor, or magnet we should call it basically, in the midpoint of the prior weekly range. In a picture-perfect world, we do not go back down there. Why is that? Well, certainly starts to look like a look above and fail back down into the range, and now we have, from the weekly perspective, a big-time lower high, unlike what we've been looking for, or looking at, I should say, in the SPY and the QQQ. So lots of concerns out of small caps right now, and I do think rightfully so, given the structure that we're dealing with here. The most optimistic thing that we could see is really support off the top of the weekly range that we've broken out of, and I'll show you that here on the daily. It's 179, right? It's 179. So first and foremost, zooming in, there's your weekly balance. Nothing about this chart would suggest a reversal yet, but 179 is the number. You've got your daily 200 SMA, daily 50 SMA slowly creeping there, right? The weekly 50 SMA, weekly anchored view app from the October low. So lots of reasons to be looking at 179. We can also add in our anchored view apps on the daily time frame from the October low, all the major pivots that we've been using so far, right at that level. 179 is the battlegrounds for IWM as we move forward, and hopefully it's abundantly clear as to why. Let's take a look at the hourly time frame chart to get a little bit more granular in our analysis. It was a very, although the IWM chart is undoubtedly bearish, right? It was very difficult to actually trade this intra-week unless you went for the gap fill reversal on the Friday session, right? This move up here was low confidence in both directions. We talked about that on Wednesday. And even on the first attempt, Thursday morning, to get underneath our single prints and into those areas down here, right? What did the market do? It got bought up and it went sideways. So it was really the gap down from Friday that caused the damage. Gap fill reversal confirms it as bearish. 179 should be the battlegrounds once again, and we can see that clear as day here on the hourly time frame chart. So 179 is the key level on the downside. What about the upside? Obviously, it's going to be your breakdown point, which is here at 184.75. It's where the market failed to resolve higher. Remember that this attempt on Wednesday afternoon was looking good until it closed weak back at the level. Thursday puts us in, no man's land, and Friday's gap down is the end of the deal there. What else can we see? Well, taking out our good old friend, the anchored view app, a couple of adjustments to make here. First and foremost, let's go to the second, which is going to be your gap up day from over here. Right, that is confluence of resistance now at the upper bound of the expected move. 184.35 is that number, by the way, and 184.75, the neckline of this, which can now confidently be viewed as a head and shoulders. Right, where else can we put this anchored view app? Let's sorry for all the clicks here, but we've got to go forward to the 13th. There we are. That's going to be the top of your consolidation range up here, and lo and behold, what's that magic number? 184.75 strikes once again. So IWM, we know our two key zones. Overall, for the broad market, this is not helpful. 179 really wants to hold if, again, broad market-wise, we want to see a constructive look in the upward direction. Remember that when the Russell broke out back here, it spoke to the rally being broadening in nature, not contracting. If we fail 179, it would speak to the exact opposite, right? The rally would be contracting in terms of market breadth if it decides to continue in the upward direction. direction, or this would just add downward pressure across broad markets as a whole, aka your S&P and your QQQ. Let's take a look at the market internals for the Russell side of things. Certainly bearish intra-week here. Nothing really breached our negative 200 million though out of the Russell side of things. In trend lower zone on the Friday session. Once again, more substantial damage done here in the Russell side of markets, and same idea with the cumulative ticks. Very similar to the NASDAQ side of things, where clearly there's some more selling pressure. If we take a look, so that's supporting the move lower that we've seen basically is the takeaway, right? In terms of the market profile, notice that the point of control migrated lower with price in an instant on the close of Friday's session. What would that tell us here? It really doesn't support that this is positioning for a buy side move in the upward direction. And as a matter of fact, if I just flip back on over to the internals here and look at the tick, if this was going to be a buy side position into the close there, which causes the point of control flip to the bottom end of the range, you would have seen the tick up here in the very positive territory, over 500 for our Russell. It simply wasn't the case. We hang out low. So to me at least, I have to assume that instead of this being positioning or accumulation for a long in the upward direction off of 179, it's like people are just hitting the tape, sell, 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 get me out of this thing. I don't want to carry this over the weekend. Now, we do have a poor high and a poor low, but for the most part, that's really it. Everything about the IWM is far more bearish than what we've seen in other indexes in today's episode. And it makes sense, right? If you think about regional banks, where are the smaller regional banks in terms of the index that they're represented by? IWM is the one, right? If you remember back to the banking crisis, SVB, this was impacted the most. So all boils back down to, we can see in today's video, financials are the thorn in the side for broad markets. If you've made it to this point in the video, I truly appreciate you being here. I know it's a super long one today, but hopefully you can hear it in my voice. I really do get fired up when it comes down to uncovering where the deficiencies are in the market, what's going wrong, what needs to improve, and what is the game plan for the coming week's worth of trades. So with that said, let's continue along. Core listed companies, skimming it. Considering it's not financials, it's mostly tech, we're going to be dealing with higher highs, really. So Apple, higher highs over 186.65, blue sky territories. As long as we're consolidating over 184.50, good to go. Lower highs underneath 184.50 start to turn this into a double top. I would look for some mild downside outcomes, nothing major. 182, 179.50 would be the next level. Next up is Netflix. This double top is really proving to be a little bit more than just a minor hourly double top. Let's go there actually to the hourly and take a look at this thing. You can see the consolidation and balance down here at the lows. The first hourly bar produces a gnarly upper wick there. Not convinced that it's an obvious long out of Netflix until this turns into an inverted head and shoulders, aka higher low and break of the neckline above 426.85. So watching for that out of Netflix. Obviously higher low above the neckline would also be valid. Their target would be 436.50. If we just consolidate in the range, treat it as bear flag consolidation, lower gap becomes the target. 414.75, 410.50 is the closure. Tesla, what's going on? This is still an hourly time frame chart, folks. Falling back down into the consolidation range from here, you can start to call it a head and shoulders. Just remember, it's not a head and shoulders until it is, meaning that we get the lower low underneath 250.75. So that's your key level to carry forward, or higher lows above the top of all of this nonsense from back in here at 262.50, trades back into the equal high at 276.75. So really neutral, not a whole lot to talk about structurally in here. Better like this or better like this for the downside gap to come into view. Next up is going to be Google. Also another tricky one, still on that hourly time frame chart here. Let's actually go to the daily because this illustrates the trickiness, right? If we think about the Google daily chart, this technically is head and shoulders. This 122 is that key level we discussed in multiple videos over the past couple of weeks in pre-market preps. The Thursday rally really complicates things, being a bullish engulfing bar, and on Friday we have a bullish inside bar over the 50% mark and closing back at the highs, and also over the 122. So I'm not convinced that this is an easy trade to pull off. If anything, it's starting to look more like look below and fail, perhaps target the top in here. But if we just go back to the hourly chart, notice that we really struggled at this area, 123.75, for the most recent lower high underneath. So little cautious of this one. Want to see either further price acceptance over 122 for that rotation, or a prompt fallback down underneath and proof of concept with a lower high below before looking for the follow through underneath 120.15. Next up is Zuckerberg's Fantasyland. What's going on over here? Is he going to fight Elon Musk? I think the answer is yes. Make your bets. Place your bets if you've got them. Let's go to the daily chart actually here. Balance range in play and breaking out on the Friday session. I mean, incredibly strong. The best strength that we've seen so far in today's weekend update. So watching Meta as a long candidate, right? If this is a daily bull flag, measured move tells us that we have some room to run overhead. Technically, 289.60 was our prior gap level, right? If we do something like this, I'll show you this structure. Remember that it wasn't technically the full gap close. It was the low from back here. The full gap close, thanks to who pointed out in the comments section, is 317. I would also be mindful of 307.50. Not calling for that this week, just pointing out that there is some room to run gap-wise in the overhead direction, and the chart does continue to look bullish. The only way that I would really feel that this chart has the opportunity to deteriorate is if it turns into a look above and fail, meaning that we get a lower high underneath 286.50. Next up, NVIDIA. What's going on with the pie in the sky AI mania? Consolidation, but starting to look a little bit more like distribution with the rounded type top coming in here. It's not just a sharp pullback that, offers a buying opportunity, then we're back off to the races. It's like we tried to incrementally go higher, wasn't working, tried to buy this pullback, wasn't working, right? So in here, it seems more like distribution to me just based on that perspective. You could also start to call this descending triangle. 421 is your key level, lower highs underneath. Trade it for downside outcomes 411.25 and 401 beyond that. What's going on with Softy? Some concerns here with the lower high here underneath 338. So watching for the flush basically under 334.25 brings you to your prior breakout point from here at 328.65. Shorts on the table with the daily lower high kind of being cemented at this point in time. Looking at the daily chart, right? Kind of have that activity with the inverted hammer from Friday. Last but not least, the mini beast. We've got Amazon and then 6 trade ideas. This video is going to be just absolutely a giant. But anyways, Amazon. Inside bar, not really inside, I take that back. Breaching the Thursday high briefly and then closing in the upper third. That's really more of an appropriate assessment here. For a mild suggestion of a pullback, if we do break Friday's low at 128.60, 127 becomes the key zone to hold. That, remember, was an ascending triangle breakout point. If we're above it, it's a break, higher low, looking for the gap to close overhead. 130.130 closes to 134. More price acceptance under the 127. Maybe it turns into a look above and fail. Bottom end of the range would be the target at 121.25. For the video that never ended, we've got 6 trade ideas. MDB, MongoDB is up first on the chopping block. What do we see here? A beautiful daily balance range has built out after an earnings gap up, which is holding, obviously. And we've got ourselves a 3-bar play as of the Friday close, staying above the 50% retracement of Thursday's range. If we can break 400 in the upward direction, a measured move coming from a double of the range here should bring us closer to 430. Ironically, we have weekly structure up at 436.73, and you can clearly see, based on Thursday's activity, that Mongo has no problem traveling that range over a short period of time. So MDB, bullish idea there. Next up is CRWD for CrowdStrike, and this is a bearish trade idea. So we trade in both directions. This is much more firmly in bearish context, and the reason I say that is because you can clearly see already a daily double top with an equal high, not a higher high, equal high, and we've already produced a breakdown of the neckline, giving us a lower low from here to here, bearish context. So if this continues to play out, we have an inside bar on Friday. Treat this as a bear flag. A flush brings us to our prior breakout point here. This is thin structure on the rotation higher. It's not the biggest range, but 3 points is definitely tradable early on in this upcoming week. If we go beyond that, the next target is at 135.57. This one was 139 if you didn't catch the number on the first go around. Next up is going to be MA, MasterCard. What's going on with this? Ascending triangle potentially getting ready to set up a breakout here. You can see the consecutive higher lows and the flat top. If we look left, there is a gap to close here, and the rough target should be the high. If you take a measured move from the triangle pattern breakout, it extends through that, right? So 392 would be the upside target on a breach of 380. We're trading for longs in the upward direction as that potentially unfolds here. Next up, we've got SBUX for Starbucks. What is this one? This is a bearish trade idea. If you think about this, again, we're trading both sides of the coin here based on structure. This is a really sloppy and ugly, I maybe should do it like this, head and shoulders with I would call it an acute right shoulder at this point, but may take some time to develop. But we've got thin structure as the market moved higher back here. Breaching the neckline at 96.60s gets interesting for the 5-point rotation closer to 91.80s. So looking for some downside out of Starbucks only if it can breach that. You can call this an H pattern, call it whatever you want. We've got a lower high in play. We're sitting on the equal low. If it wants to flush, if the broad market wants to continue to pull back, strikes me as a reasonable candidate to follow suit. Let's take a look at SQ is the next trade idea. Zooming in on this one, The idea could be for continued short activity up against 63 and rejections there, but I'm actually looking at this as an optimist. And, this does go counter trend, right? We do have the same double top. We do still have the same break of the neckline, like what we just discussed in some other setups. But look at the hammer candle that's printed on Friday off the 50 SMA, off of the retest of the breakout point from back down over here. It doesn't mean that it needs to unfold, but the risk reward here looks very favorable to me. If we can get something that gets price acceptance over the 63 level and we can get an entry close to this zone in here, place a stop loss underneath Friday's low, you can see that the risk reward here certainly starts to look favorable for a retest of the double top back around 67.21. The odds may not be in our favor because of the daily downtrend, but it's at least worth monitoring into the end, or at least the upcoming portion of this week. Last but certainly not least is a longer time frame idea. For this one, we're going way out to something like a monthly time frame chart with max available data. This is something to put on a watch list and put an alert out there and just continue to monitor it, right? Look at Disney. All the politics and recent stuff in the news aside, the technical chart is daunting. Why do I say that? Well, from here to here, we go higher high. You better believe that there were likely a lot of breakout traders, or at least investors, interested in the new 52-week highs after the whole sickness low back here. Everything's reopening, great, fantastic. 100% retracement of the move and nothing but bearish consolidation on a monthly time frame chart. The current monthly bar is building out as an inverted hammer. Obviously, we've only got 1 week left to go. If that closes out as a small inside bar inverted hammer, big trouble underneath the monthly 200 SMA, underneath the lows of this move in here. You're looking at roughly 87.50s. Failing that, structurally, the next major support comes way down here at like 65 roughly. Again, this is not something that's going to unfold overnight, but it's something I wanted to bring up in today's video. The idea is incredibly interesting to me, considering this madness in here. Very minor lower high. You can continue to drop it down through the time frames and evaluate this thing. This is just, let's grab this tool. This is just a descending triangle, right? So from that perspective, makes sense as well. Let's go to a daily time frame chart. We certainly are putting in, maybe a double bottom down here, but nothing convincing yet. You'd have to clear this neckline. Big gap down from earnings. Everything is kind of pointing to lower out of Disney. So just watching this as an idea. I'm not going to waste any more of your time. Do with this idea what you will. It probably goes on the back burner for me, but that's going to wrap up today's episode of the Weekend Update. If you enjoyed the video or learned anything new in this extended episode today, let me know in the comments section or by giving the video a simple thumbs up. If you made it to the very end, let me know in the comment section by saying charging adapter. I'm just looking at my desk here, charging adapter down below in the comments section. I'll know you made it all the way to the end. And with that said, I hope to see you on the pre-market prep Monday at 8:15. I wish you all a green trading week.